Good afternoon, everyone, and thank you for joining our Sustainable Investment webinar. I'm Luke Sheather, Investment Specialist at Capital Partners, and today I'm joined by Founder and CEO David Andrew as we look to discuss some of the key issues facing sustainable investing in today's environment. A recent survey we conducted found that over half our clients are either interested in investing sustainably or at least interested in learning more about it. So today, we're hoping today will provide an opportunity for David and myself to have an open and informal conversation with you all and to address some of the issues and concerns that you might have. We do have a very loose agenda that will cover off on some topics such as the emergence of sustainable strategies, some of the approaches to sustainable investing, some of the challenges that advisors and investors face in the industry, and how our investments today can make a tangible difference to the environment and our social values. So David, welcome.
Thanks, Luke.
Perhaps we can start by talking about how it is that Capital Partners have become involved in sustainable investing and what sustainability means to us at Capital Partners.
Yeah, I guess it probably started out as a bit of a passion project and bred out of the fact that as a firm, we've always sought to run our business sustainable. I guess we're 21 years in, and in our profession, even that says something. But really, for us, sustainability means doing the right thing by our clients, doing the right thing by our team, and doing the right thing by the community and humanity more generally, I guess. And we could see this groundswell of interest in sustainable investing coming for quite a few years. And we've been grappling with how we actually deal with that at a practical level. I guess philosophically underpinning this, we have a belief that capitalism is actually an incredible force for good. But we're not misty-eyed about it. We also completely understand that it's not perfect. As a method of allocating economic resources, capitalism is very, very efficient. So I guess we look at it and say, well, let's say if you could just turn that a little bit and talk about it being conscious capitalism. You know, capitalism that has a sense of consciousness around the environment, has a sense of consciousness around social issues, has a sense of consciousness about doing the right thing by investors from a governance point of view, then capitalism becomes an even better system, I guess. So we started a project some time ago. It was actually my son, Tim, who interned with us and really started to get into the meat and potatoes of the research in terms of what works, what doesn't work, and what is sustainable and implementable.
Sure.
Because it's easy to have lots of good ideas, but you've actually got to be able to implement them in a really practical way. So we, as a firm, adopted the definition of sustainability that is serving the needs of society in the present, without undermining or compromising the ability of future generations to meet their needs. So I guess as leaders in the financial services industry, certainly in Western Australia, but we have a voice nationally, we wanted to meet a clear demand of clients who said, look, this is how I want to invest. We don't have a sense that this is for everybody. But we have a sense that for the people that have really engaged in the sustainability conversation, and we'll unpack this a bit later, I know, but we really need to provide them with an investment solution that meets their needs.
Sure. We've certainly seen sustainable investing grow in popularity, not just here in Australia, but around the globe. I came across a stat just the other day that over half the money managed in Europe today is now managed to some form of sustainable mandate or sustainable strategy, which I think is just impressive and staggering. Whilst Europe has been the front runner, if you like, in the shift towards sustainability, it is expected that other countries like Australia will soon follow suit. So why is it, do you think, investors are starting to take more of an interest today?
Well, I think there's some very clear social reasons for that. Sustainable investing is not new. It started with the Wesleyan Methodists, where they just didn't want to invest in alcohol and tobacco stocks during the temperance movement. And it's really been around for a couple of hundred years. If we think about it in the context of social change, in the 20th century, late 20th century, there was a very clear sense that people could go to the ballot box and express their will, and that politicians would listen and that things would change. And I think, and certainly the research supports this, the evidence supports this, that as particularly climate change and global warming has become a bigger issue, the political camps are so opposed to each other. Those who don't believe it's a man-made issue, a carbon issue, and those who believe it's just natural warming and cooling cycles of the planet. I have a really strong sense that voters have become very frustrated about that, because even people who might traditionally vote conservatively in their economic politics have a very strong commitment to the economics of climate change. So they haven't been heard. So that has, and I think social media has had something to do with this too.
Sure.
Where consumers and investors are now voting at the checkout, and they're also voting at through their investments. So they're taking a view of, I want my money invested a certain way, and I can really understand that. So to give an example, whether it's a good example or not, before there was a plastic bag ban in Western Australia, I used to see people at the supermarket with their string bags. They were, as consumers, making a statement to say, I'm not going to use single-use plastic. Similarly, people who know me well know that I spend a fair bit of time on my little organic veggie garden. That's because we want to eat clean food. We don't want food that's, it's the most expensive organic vegetables in the world, I might add, but we have a lot of fun doing it. But people who make that choice at the supermarket and they buy organic food and they don't buy a lot of processed foods, and they buy food, for example, or for example, they might say, I'm not buying the sparkling water stuff, the mineral water from that's been sent on a ship from Europe. I'm going to buy stuff that I can produce in my own kitchen, because sea miles and all. So consumers are really making decisions, and I think they'd be forgiven for saying, "Gee, am I really making any difference?" But if enough people do it, it makes a difference. And the same thing flows through for investments. If enough people make these choices around where they put their money from an investment point of view, in aggregate, it will make a difference. They want to send a message.
Sure. And I think another reason why we're starting to lead more with sustainable investing today is the fact that there are now adequate investment solutions available.
Yeah.
Sustainable investing is not a new idea, as you discussed. It's been around for centuries. But during that time, I guess the investment infrastructure and investment landscape hasn't quite been up to scratch to allow investors to make the switch easily and efficiently. But I feel like today that's all changed and the investment world has finally caught up. For instance, MSCI, who are a global index provider, now provide ratings and sustainability scores for over 8,500 public companies. And it's developments like these that have made it easier for advisors and investors to construct sustainable portfolios.
Yeah, it's very much been the domain of the institutional investor. That's
Correct.
right. Yep.
So David, maybe I think it'd be worth discussing some of the various approaches that an investor can take in relation to sustainable investing.
Yeah. So this, I think, is part of the challenge. Everyone is going to have a different view on their sustainability credentials. Everyone's going to have a slightly different view on how they want to have an impact. For example, for me, I have a belief that, market forces will ultimately solve the fossil fuel usage issue. I think it'll just become part of, but it does need some government intervention to get that to happen. But let's just come back to this slide, I think, and then I'll explain a little bit more detail. So financial return, we as a firm are really, really clear that we do not want to throw the baby out with the bathwater and have an amazingly impactful investment portfolio that ticks all the right boxes from a climate change point of view and from a society point of view, and basically fails to meet the needs of the investor.
Yeah.
You know, we don't have many clients who can afford to say, I don't care about my investment return over the next 30 years, it's irrelevant. All I care about is the social impact that I'm going to have. Honestly, I don't think we have any clients that would fall into that category. So sticking to our investment philosophy is the number one rule that we put in place. How can we combine these potentially competing forces?
Yeah.
The second thing is, does it have the impact that I want? And we'll talk a bit more about this, but I don't think we can please all of the people all of the time. But what we can do is build portfolios that can have a really, really significant impact if you look at it at a headline level. And again, I know you've got some more detail on that. And then, do I feel different? So let me give you a very personal example around, do I feel different? Every time there is the news in the United States about a mass killing, you know, weapons of war, handguns, that sort of thing, I know that I feel very comfortable about the fact that I'm not committing any of my new capital to those sorts of investments. Now, this is where it becomes complex, of course, because my portfolio has been in place for a long period of time. So for me to switch everything across to sustainability, it is a huge capital gains tax event.
Correct, yeah.
You know, so every single person that has to deal with the sustainability issue has to deal with those sorts of impacts. But every new dollar that I invest is being invested in such a way that it's not invested in weapons of war, it's not invested in handguns and so on. And I do feel good about that because I feel confident that I'm still meeting my investment needs.
Correct. So we're talking about some of the different approaches to sustainable investing. And I think the next slide here, we'll walk through that now. So as we walk through this slide, David, I think it's important that we understand the key differences between each of the approaches. In particular, the trade-offs that may be required in pursuit of a particular outcome, whether it's financial or societal. So if we first focus on the left-hand side in the yellow highlighted box, these approaches are mostly interested in maximising financial returns.
That's what we've all grown up with.
That's what we've all grown up on.
That's what everyone's used to.
That's what we're familiar with, correct. So these types of portfolios may have companies that sell alcohol, tobacco, firearms, and so on. Conventional approaches have no consideration of environmental, social, or governance concerns, where passive engagement might encourage companies to engage in responsible behaviour by way of shareholder voting at AGMs, for example. Now, if we shift our attention to the other extreme, to the far right-hand side of the slide here, David, we come across approaches that prioritise sustainable outcomes as opposed to investment return outcomes. They trade off return to maximise impact, if you like.
Well, with philanthropy, you know, you're essentially giving money away, right? So there you are getting potentially a huge social return, but you're getting no financial return.
Correct. So philanthropy is pretty much targeted spending with little or no consideration for investment return. Now, this might include donations to causes of value like to wildlife protection, for example, where impact investing is a highly customised portfolio, usually only targeting one or two sectors, maybe renewable energy, for example, and tends to leave out whole sections of the market. So as a result, diversification is obviously sacrificed. Now, if we come to the middle ground here, and David, this is the space that is most appropriate for the majority of our clients. Sustainable integration attempts to balance returns with social outcomes. And it does this by starting with a conventional portfolio that is diversified and then applying ESG screens to eliminate or reduce some of the environmental and social impact.
Can I just check you there, Luke? So
Yep.
we're using, not having a crack at you, but that's the jargon. So ESG stands for environmental, social, and governance. So
Correct.
environmental, I think everyone gets environmental. Social, we'll talk a bit more about that in a moment. And G, the G is the governance, where that's where the conscious capitalism thing comes in. We just want people to do the right thing.
Correct.
We want all companies run well.
Correct.
You know?
Responsible behaviour.
Yeah.
And socially responsible investing, David, is just a slight extension of sustainable integration. And that includes stock-specific decisions or exclusions by clients that relate to their particular taste or preferences. And as a result, again, diversification is often sacrificed in this approach.
So the social responsible investing, you've got more say as an individual.
Correct.
As in terms of what might be in and out of the portfolio.
Correct.
But your trade-off there is because it's a solo portfolio, by definition, you have to trade off a huge amount of your diversification benefit.
Correct,
Yeah.
Which often leads to less reliable investment outcomes.
Yeah, makes sense.
So from there, David, we might discuss how capital partners think about building, sustainable portfolios. And in that respect, there are two really important considerations that are front of mind for us as advisors as we construct these portfolios. Firstly, you must acknowledge that every client has different preferences, and there's no two clients that have the exact same feelings and opinions about every company in their portfolio. For instance, you might think Facebook is a fantastic company, highly innovative, the future of advertising, not to mention they're the 5th biggest company in the world. So from your perspective, you might think they're a must-have inclusion in your portfolio. This is just hypothetical, whereby I might have concerns about their data privacy breaches and therefore wish to exclude them from my portfolio. Again, just hypothetical.
Yeah, it's really hard. And similarly, Westpac recently was a great example where people were outraged about the Austrac breaches.
Yeah.
And other people were really willing to say, okay, well, it's a mistake. I suspect all banks were a party to this, but banks remain such an important part of they're the 4 pillars, of the Australian financial system.
Sure.
And if you excluded all of the banks, what would that represent? That would be about half the market capitalisation of the Australian share market.
Yeah, good 30%.
So on the basis of the Hayne Royal Commission, yes, all the banks did some bad things, but to exclude them all would just blow a massive hole in your portfolio diversification. So you think about that in terms of, well, what have they done about it? So Westpac lost a chairman, they lost a CEO. They're completely reworking their AML and anti-terrorism and money laundering systems in order to prevent those things happening again.
Yeah.
So this is where it becomes quite challenging around, a headline pops up and immediately people say, well, I want that out of my portfolio because I've got a really strong view. That's difficult to do because you have all sorts of tax considerations and the like.
Of course. So that's the first consideration. The second consideration for us as advisors is, regardless of how sustainable minded we are, both personally, you and I, or as an advisory firm, our ultimate responsibility is to give our clients the best chance of achieving their financial outcomes. Particularly if we're investing our clients' core wealth, we want an investment solution that is going to look after them from a financial perspective, but also provide them with a sustainable experience, which is why we think that the integration approach is the most suitable approach for the majority of our clients. So when we're constructing our portfolios for sustainable investors, our starting point is actually our investment philosophy, which I think we've got a quick slide here, Janko.
Might share that one, Janko, thanks.
Yeah, thanks, Yanko. So most of you watching would already be familiar with the beliefs and principles that define how we invest at Capital Partners. But at a very high level, we believe in building diversified portfolios that have a meaningful exposure to the drivers of high expected returns, being smaller companies, value companies or lower price companies, and highly profitable companies.
Also, when we're talking about diversification, we're not talking about a portfolio of 20 Australian shares.
No.
We're talking about a portfolio of hundreds.
Most of our Capital Partners diversified portfolios may hold up to 8,500 companies.
Yeah.
So very diversified.
And I think that puts in contrast, that really brings into stark contrast the challenge between an integration portfolio, which we can do very effectively, very efficiently, and at quite low cost, versus the SRI portfolio, the socially responsible portfolio, because you can't build a socially responsible. It's much harder to build a socially responsible portfolio with 8,000 stocks.
Correct. And you're sure to find some stocks you won't like in that 8,500.
Yeah.
So this is the foundation, if you like, David. This is the starting point for any portfolio that we build at Capital Partners, these principles here. For our sustainable offering, from there we incorporate some ESG screens, which we might run through in some detail now. So we have environmental, social and governance screens. David, you might like to run through these.
Yeah, sure. Have we got that up, Tanisha?
Yeah.
Yep, that's great. So on screen you can see environmental, social and governance. Now governance, I won't speak to in great detail because this is not unique to our sustainable investment offering. The governance screens cover all of our portfolios, sustainable and conventional. And that's really because we want to partner with organisations managing the money, the institutional managers who care about these things. So things like executive pay, toxic spills, all those sorts of things, or topical today, sexual harassment, that sort of thing. We will, through the institutional managers, be very vocal about those sorts of governance issues.
Sure.
Environmental and social is where the real action is, because let's say we start with our conventional portfolio, and I think you said 8,000 stocks. Let's start on the environmental column first. The challenge there is to exclude or underweight the top contributors to the problem in any of these categories. So greenhouse gas emissions intensity, all of the big emitters are excluded from these portfolios. So, the big power generators, for example, AGL and others. Then you've got potential emissions from reserves. So that includes Woodside, it includes BHP because they've got oil reserves, just to name a couple. Then you've got land use and biodiversity, toxic spills and releases, operational waste and water management. Now, one of the things I do want to draw out is that when people look at the stock list of our portfolio, they will see miners there. And I think this is one of the real challenges of an integration approach, where you say, well, hang on a minute. And people have said to me, I don't want mining companies in my portfolio. Yeah. And you say, well, hang on a minute. We're living in a modern society. We live in houses with, Zincalume colorbond roofs. Yeah. We have colorbond fences. We drive to and from work and to and from our meetings in cars that are made of steel and aluminium. Yeah. And this is the really challenging bit. So we're not trying to exclude everything that everyone might think is a problem in their mind. What we are trying to have is the maximum impact possible from an environmental point of view, with the minimum of impact on the financial outcome, if that makes sense. Yeah. So you look at these environmental factors, the impact that we can have for investors through these screens is really profound. It's really, really significant. And if your primary concern, and that's certainly been the research focus and the feedback that we've had, is that people want to vote their money on greenhouse gas emissions and the use of fossil fuels. That's their number one concern.
Yeah.
And I think this strategy does an amazing job at reducing those key levers. The other areas, land use, biodiversity, toxic spills releases, operational waste and water management, for example, we're not going to exclude everything in the whole of the portfolio that might have an issue there, but the worst of the polluters will be excluded.
Yeah, the worst of the bad bunch.
Yeah. The other thing I want to just raise here as another complexity that I think it's really important that our audience has a sense of is take two companies that are big emitters. One is Shell in the global portfolio, the conventional global portfolio, and the other is AGL in the Australian portfolio. Now, both of those are exclusions in the sustainability portfolio. But what's really interesting, AGL has made huge announcements. They're spending $3 billion, I think, on moving to renewables.
All their free cash flow, I think, right?
Yeah, well, Shell has committed all of their free cash flow to non-fossil fuel development. So there's not going to be a lot of money spent, in fact,
elsewhere,
with Shell on new exploration. They will spend money on developing existing fields, but they're not going to spend money on new exploration. Now, that's really interesting because at some point, people are going to look at AGL and say, yes, okay, historically you've been a big emitter, but you're now doing so much in the renewable space that really we're challenged as to whether you should still be an exclusion. Maybe we should be including you back into the portfolio.
Yeah.
So the reason I raise that is that both of those companies are good examples of why this process is a very dynamic process on an ongoing basis.
Sure.
It's also a really good example of why, and Rio Tinto was a good example of this. There's been some horrible headlines around the Juukan Cave disaster, but the managers don't and can't just immediately say, right, that's a terrible outcome. It is a terrible outcome, but we're going to exclude that from the portfolio. It kicks off a range of conversations with management and the board. And again, the chairman, the CEO, and a whole range of senior leaders in that business have gone.
Yep.
So it's very complex around just making knee-jerk reactions to the headlines. We really do want to maintain portfolio stability. And if over time, the stewardship committee that sits behind the portfolio decides, yep, that's any particular stock is a problem, then they would become a portfolio exclusion.
Sure.
Yeah. So let me just spend a little bit of time on the social. Now, these are generally exclusions. So factory farming in the Australian context, Ingham is an exclusion, the chicken people, because they are factory farmers. Hormel Foods in the United States are the makers of Spam. The Spam, you won't remember that. It's not your generation, but my generation and old generations remember Spam. Hormel Foods is factory farming, terrible practices. So they would be an exclusion. Cluster munitions and landmines, weapons control systems, alcohol and tobacco, child labour. Now, child labour is really interesting, and this is one of the things I like about the way our strategy has evolved. So I've got some really bad news for our audience, and that is that in this in the sustainable portfolio, both Nestle and Lindt would be exclusions because there is too much evidence that they've got exploitative child labour, and I think, is there any other sort of child labour in their downstream processing? So if you look at Nestle as a headline company, they're pretty much a model citizen, but they're not doing enough in their supply chain to make sure that they can guarantee sustainable, responsible sourcing of their chocolate ingredients. Yeah. So they're an exclusion.
Sure.
So that again, and you look at that, well, what's the impact on that? Well, what we're trying to do is send a message. What the consumer, what the investor is trying to do, it's not capital partners, but what the investor is trying to do is to send a message to say that's not okay.
Yeah.
Similarly, with adult entertainment, there are major entertainment brands that have quite complex and developed adult entertainment businesses. And you sort of think, well, that's not really consistent with where I want my money to go.
Sure.
Perhaps. And then, of course, I mentioned earlier the personal firearms. Yeah. So I think when you look at what's excluded from the portfolio, you still end up with a very large number of diversified portfolio names, but the most egregious of the polluters and the most egregious of the social issues are dealt with really effectively.
Yeah. And David, just while I think about it, we encourage all of you watching at home to ask questions via the chat function at the bottom of the Zoom.
Oh, we've got a question. Tanisha, fire away.
This one is from an anonymous attendee, and they ask, what makes a company sustainable for it to be considered as a sustainable investment option? Is there a set checklist they need to meet, as in government ASIC standards?
Good question. Do you want me to lead off with that?
Yeah.
That's a really good question. No, there is no set checklist to make that easy. The very large organisations that sit behind markets like MSCI, which is, I think that stands for the Morgan Stanley Capital Index organisation, they do provide a sustainability score. Yeah. So that really does help. And increasingly in Australia, it's becoming the case that large listed companies need to provide a sustainability report as part of their annual report, and that's how they get their sustainability score. The way we have to, because we're building portfolios that we want them to be diversified and we want them to be accessible to a lot of investors at relatively low cost, we have had to partner, and we've had quite a bit to say actually in the process of how these portfolios have been built, where the number one issue is climate change. So if you're a big emitter of fossil fuel CO2, if you hold significant reserves, then you're going to be in exclusion. And then if you are bad as far as biodiversity, toxic spills, releases, operational waste and wastewater, then you'll be excluded. A company that might have one bad mistake, but then put in place really rigorous processes to make sure that that's managed for the long term, might not be excluded, because they might have a very long history of responsibility. Yeah. And I think that's part of the Rio Tinto story is, they have got a really, really strong track record of Indigenous engagement going back many, many years. They've built communities in the Pilbara and other places, and they give a huge amount of money to Indigenous development and employment and so forth. So not everything they do every day of the week has been terrible. The reason I raised that particular example is there's a lot of subjectivity that goes into this, and it's about when you aggregate together all of the decisions that are made around sustainability, what's the overall outcome for the portfolio? And I know you're going to talk a little bit about that. So it would be so much easier, to our anonymous question proponent, that it would be so much easier if there was a checklist. But, that's not how the world generally works. People, we get paid to have a view, and we pass those views on to our the managers that represent the management of the money. And, by and large, we're really happy with the result that we get, because we get to maintain those three key objectives that we mentioned earlier, which is a strong investment outcome, a social impact, and people feeling as though they've made a difference.
Correct.
I have another one.
Another question.
Oh, good. Thank you.
If a company suddenly deteriorates in their ethical standards and is no longer sustainable, how quickly is that status removed and then removed from the managed fund investment option?
Okay.
You want to take that?
Yeah, it's another really good question.
It's a really good question. There's two levels to this, as David was just alluding to. So there's the rating agency, the MSCI, if you like, who provides sustainability scores for the fund managers to then use and create or construct their portfolio. So I believe that MSCI monitor for daily controversies to governance, and they'll report weekly to the fund managers for them to take action. In regards to, I guess, some of the smaller detail, well, not smaller detail, but some of the wider environmental issues, I believe that they're scored at least once annually. So I guess it depends on whether it's environmental, social, governance, as to how frequently these will be reported and reviewed. And then on a portfolio manager level, it really depends on how often they rebalance their portfolios. Some portfolio managers might rebalance daily, some might rebalance monthly or annually. So there can be a delay depending on those layers.
I think also too, it is all about the company's track record. So that's a very good question in that what has to happen for a company to be removed from the portfolio. And I gave two examples already about Westpac and Rio Tinto, both clearly done the wrong thing. Certainly Rio Tinto has got a very long track record of trying to do the right thing. But I'm going to contrast that with Volkswagen. Now, Volkswagen was and remains an exclusion in the portfolio. And the big difference there is that they actually set out to deceive the consumer and the markets.
It's the intent, isn't it?
Their intent was to deceive.
Correct.
That is a very, very clear, that was a very, very clear cut and dry decision, and that happened quite quickly.
Yeah.
The challenge then, of course, becomes at what point does a company like Volkswagen redeem itself and become a name in the portfolio again? You know, you do your time, you serve, what's that saying? You serve your time or whatever. You do the crime, you serve the time. That's one of those things that we're still, I think the whole industry is grappling with.
Sure.
But I think it is really important that our investors, our clients understand that this is not a reaction to a headline. You know, there's a bad headline, something's gone horribly wrong. You know, we are not immediately baying for blood. Like every single decision we make and every single decision the fund managers make, they're looking at the evidence, they're looking at the longer track record, and they're looking at what is, you know, on balance, what's a reasonable decision to make.
Sure. Is that it for Tanisha? We did actually receive one good question before today's session, asking what are some of the results that we might expect from sustainable investing, both on a sustainable level as well as a financial level.
That sounds like yours. You can answer that.
I think there's a slide here, Janko. I'll handle the financial.
Click forward, can't you?
Are we good? There we go. I'll handle the financial section. David, maybe you want to walk through this chart for the sustainable outcome?
Oh, you're batting it back to me. I was gonna give it to you. Just go back. Yeah. Okay. So greenhouse gas emissions. This is actual results from the Capital Partners Sustainable Investing Strategies. On the left-hand side, where you see greenhouse gas emissions intensity, that's intensity today. Now you can see on the left-hand bar, this is the world market, the world financial markets in total generate 138 tonnes of carbon dioxide per $1 million of sales. So that is, if you just invested in the market, an index fund, for example, that is the emissions intensity, 138 tonnes of CO2 per million sales. When we then apply the exclusion screens in the Capital Partners Global Sustainability Strategy that's managed by Dimensional, today's emissions reduced to 35 tonnes of CO2 per $1 million of sale, which is a reduction of 74% reduction in exposure, which is pretty profound. I think in the Australian strategy, it's about 67%, so not quite as big a reduction. Now, the reason you can't reduce all of the emissions is, for example, you've got the transport sector, toll, IPEC, all the transport companies. Now, anyone that's listed is going to be given a sustainability score. And what happens there is that the worst of the polluters are excluded, not all of them. And that goes to your earlier comments about portfolio diversification. You can't just go excluding everything. So if you exclude the top polluters from the Australian share market, so BHP, Woodside, AGL, and a couple of others, that's about 25% of the market capitalisation. So you've got to be really, really careful about not being too heavy-handed, because if you're too heavy-handed, you're going to lose the impact you're going to have plenty of impact around your climate change, but you're going to mess up your portfolio.
Sure.
If you look then to the screen again and have a look at the potential emissions from reserves, this is all the stuff that's still in the ground. So again, the grey bar, if you look at the MSCI World, so the index, the global index of all stocks available, large stocks available, that's 107 megatons of CO2 is still in the ground. This strategy, the sustainable investing strategy, the Capital Partners sustainable strategy, reduces those potential emissions from reserves to zero. Yeah. So for people who are really focused on making a statement about climate change, this is a really effective way of doing it. Now, as far as the current emissions are concerned, are they still going to be emitted? Yes, they are. So you're sort of forgiven for thinking, well, am I really making any difference at all? And the answer is, if enough people make that decision, ultimately you send a signal, because the cost of capital for those big emitters becomes higher.
Correct, yeah.
Their cost of capital is higher because fewer people want to invest in their company. So whilst you might feel as though, you know, you're $1 million in super and you say, well, that means I've got, you know, $10,000 worth of Woodside shares. Does it really make any difference if I make that change to my portfolio? I think it makes a difference when you've got literally thousands and thousands of people making that same decision. So yeah. In isolation, maybe not. In aggregate, absolutely.
Sure. And just to answer that question from a financial perspective, there's actually two trains of thought when it comes to whether sustainable investing leads to higher expected returns or lower expected returns. The arguments for higher expected returns point to the significant risks involved in a lot of the non-sustainable companies. And these risks can include operational risk, litigation risk, and stranded asset risk, which is the risk of a company having to write down a whole asset before its useful life is up.
Well, I think there's a great example of that, like ANZ saying we're not going to loan any money to coal mines.
Yeah, correct.
And you think, okay, that's sending a pretty significant message. That's where their cost of capital goes up. Yeah. Because they've now got one fewer bank to borrow money from.
So it's argued, or we believe that we can attract higher expected returns if we can avoid these unnecessary risks in our portfolios. On the flip side, however, there's been numerous research and economic papers to suggest that sustainable strategies may actually lead to lower expected returns. And the arguments here come from the higher demand for these sustainable companies having a meaningful effect on the price of these companies. And what that means for new investors coming into the space is that they're effectively having to pay a premium for some of these companies compared to some other lower value or higher value companies, when this obviously leads to lower expected returns because we're paying for that premium.
Well, that makes sense, because if you're excluding things like tobacco stocks, that will be a value company.
Correct.
And it's excluded. And what else would be examples? A lot of what we call pariah stocks, they're actually horrible companies in sectors that you wouldn't want to be part of, potentially, but they might have high returns.
Yeah, correct.
So, yeah, okay.
So ultimately, when it comes down to
But there's also, sorry to cut across you, right? There's also a lot of research that says that those higher prices that you might pay for a sustainable company is actually worth paying. because they tend to be better run. They've got better they've got better consumer engagement. They've got better product franchise. They've got better reputation, better governance.
Yeah.
So this is again.
Hence the arguments either side.
Yeah.
And when
so,
it comes
what are the actual results?
Yeah, so when it comes down to it, the results have been somewhat similar. I think sustainable strategies over the last 10, 15 years have slightly outperformed conventional strategies. However, whilst the average returns have been somewhat similar, the journey of those returns have obviously been somewhat different. Conventional portfolios will tend to hold more oil companies, for instance. So as the oil price swings up and down, conventional portfolios will either outperform or underperform.
Yeah, so if the oil sector is doing really well,
yeah,
conventional portfolio is going to be great.
Correct.
If oil's, just been horrible as an investment, as it was last year,
correct,
the sustainable portfolio is going to look a whole lot better.
Yeah. So we can expect reasonably similar returns, but just the path and the journey is going to be somewhat different.
Yeah. So when you, as an investor, if you see, okay, the market has returned 8% for the year, and your equivalent portfolio has returned 6%, that may well be the difference between the conventional and then vice versa. If your portfolio is outperformed, it may well be the sustainable impact that's causing that.
That's right. That's
Okay.
correct.
Cool.
Have we received any more questions, Tanisha? That's it? How are we going for time? Is that all we have time for, David? Do you have any closing comments?
Look, I think we're nearly there. I think that really, yes, I do, which will surprise you. I've always got a comment. So we are not in the business of selling, if you will, sustainable investing as the way people should go. We are very respectful of the fact that everyone is going to have their own view on this. I recently spoke to a vineyard owner and I put it to him and he said, look, I'm going to stick with the conventional portfolio, which I actually found a really interesting response. And he said, look, I do so much in this soil science and looking after my personal portfolio of business assets that I actually feel really comfortable with my contribution that I'm making.
Yeah.
And I'm comfortable that my investing in a conventional portfolio is not going to change the outcome that the world gets, which I really respect, completely respect. And then we've got other people who have different views on climate change and so forth. So I think it's really important that we're not pushing an agenda, but we're really, really clear that we do want to make viable solutions available to people who feel strongly about this. And what I expected that there might be a bit of a gender bias to this, that maybe women would, because there's that nurturing side to women, that they might say, well, look, I'm more interested in sustainable investments than others. And what I'm learning is that you can't generalize at all. Everyone's got a slightly different view.
Correct.
The final point that I do want to make is that when you do invest in an integration portfolio, a sustainable integration portfolio, and you look down the list of stocks, and we are very transparent to the greatest extent we possibly can. We provide our investors with the stock listing of actually what's in their portfolio. You will from time to time see a name that you might not be happy with. And that's the big trade-off.
Yeah.
Because moving from sustainable integration to your own customized portfolio actually becomes quite a big decision, because you are going to trade off that really diversified approach to a portfolio that you might be comfortable and control every single name in the portfolio, but you're just going to give up so much diversification in the process. So what we encourage our investors to do is to look at the big picture. You've got somewhere between a 70 and 75% reduction in current emissions. You've got 100% reduction in future emissions. You've got significant reductions in polluters, and you've got significant reductions in the major social issues. That's a very effective outcome, and that can be still delivered with high diversification and low cost. So I think at the end of the day, we've tried, and most people who know Capital Partners well know that we are very pragmatic. We've tried to be evidence-based, pragmatic, and deliver solutions that most people can be really, really happy with.
Great. We've got one last question. Sure, Tanisha.
More of a comment.
Yep.
An anonymous attendee has said, I would have thought there to be more upside and less risk these days, and hence good for capital to encourage for their own peace of mind.
Yeah, so that is not anonymous. I know exactly where that's come from. Yeah, so I won't out you. We do believe that history is probably on the side of sustainable investing. And it goes right back to the comments that I made earlier on. And let's put Capital Partners in the frame here. We are part of a profession, if you will, a sector, an industry that has done some awful, awful things to people. And I've said over the years, as I've looked at stuff that's gone on, I've said to Chris and Michael, gee, you know, we could have made so much more money. But who's interested in hot money? Like you make in business, you make sustainable profits by doing the right thing by your clients, by doing the right thing by your team, doing the right thing by your community, and doing the right thing by humanity in general. And to his point, I actually think that's the answer. You know, the move towards more conscious capitalism, you know, and coming back to that definition of what sustainability is, meeting the needs of the present without compromising the ability of future generations to meet their needs.
Yeah.
That's a really, really powerful conceptual framework in terms of how we live and the consumer decisions we make, not to waste and knowingly do things.
The detriment.
Yeah. You know, and I know farmers who are really anxious about some of the decisions they've made over the years around chemical usage, and they're really trying to do something about it. So they're trying to introduce regenerative farming techniques into the mix. And I think to that last question, that's the answer. If everybody sets out to be a little bit more conscious about how they consume, how they invest, then we are on the right pathway. It might not be going quickly enough for some people, and I get that, but I think we're on the right
Transmitting.
pathway. Yeah.
That's it. Okay. Thanks, Tanisha. Thank you all for watching. We've had a great time. Hopefully answered a lot of your questions. I believe this will be made a recording, Tanisha. So this will be made available to clients in a few weeks' time.
Just one quick thing. If you do have an interest in learning more about this, you are very, very welcome to call or email me, call or email Luke, and of course your advisor is always there for you. So if you have a question about sustainable investing, just ask any one of your team members, and they'll be more than happy to provide you with any information that you might like. So thanks, Luke. It's been fun.
David, yeah.
And thank you very much for joining us.
I'll catch you soon. Thank you.